Do you feel like you're losing money every time the market crashes? What if you could turn those losses into a powerful tax weapon? The answer is simple. Use tax loss harvesting. Realize your losses. Cut your tax bill. Why does this work? This slide explains everything. What is tax loss harvesting? It's the strategy of selling assets at a loss to offset your capital gains. Simply put, you cancel out gains with losses to reduce your taxable income. Let's look at a concrete example. Stock A has generated $10,000 in gains. Stock B is sitting at a $5,000 loss. Do nothing, and the full $10,000 is taxable. At a 15% long-term capital gains rate, that's a $1,500 tax bill. But realize that $5,000 loss in Stock B and your taxable gain drops to $5,000. Your tax bill falls to $750. That $750 difference stays in your pocket today. This is a legally recognized strategy. When conditions align, it reliably improves your after-tax returns. This isn't a theory. It's an established tax strategy recognized by the IRS. And you can start executing this today. Review the gains and losses across your holdings. Identify assets sitting at an unrealized loss. Realize those losses before year-end. Your tax burden changes. Today, I'll show you the evidence behind this strategy. Here's a critical point most people overlook. What happens when your losses exceed your capital gains? Here's the reality. Excess losses can be used in two powerful ways. First, you can deduct up to $3,000 per year directly from your ordinary income. One important note, if you're married filing separately, that limit drops to $1,500. This means you can reduce taxes on your wages and business income as well. For a high earner in the 37% bracket, a $3,000 deduction alone saves $1,110 in taxes. Second, any losses beyond $3,000 carry forward to future tax years, and there's no expiration date on this carry forward. 5 years from now, 10 years from now, those carried losses keep working for you. Let's walk through an example. Say you had a year with $8,000 in losses and $3,000 in gains. After offsetting, you're left with a net loss of $5,000. First, deduct $3,000 from your ordinary income. The remaining $2,000 carries forward to next year. If you generate $2,000 or more in capital gains next year, that carry forward offsets it. Losses don't disappear. They accumulate as ammunition for future tax savings. But here's a critical trap waiting for you. Step into it unknowingly, and your tax benefits evaporate. That trap is the wash sale rule. Here's how the IRS defines it. If you purchase a security that is identical or substantially identical to the one you sold at a loss within 30 days before or after the sale date, that loss is disallowed for the current tax year. That's the sale date itself, plus 30 days on either side, a total window of 61 days. But here's an important nuance. A disallowed loss doesn't simply vanish. Typically, it gets added to the cost basis of the replacement security, deferring it to a future calculation. In other words, a loss you can't use this year gets reflected when you eventually sell. So how do you get around it? Two methods. The first, wait at least 31 days after the sale date before buying back the same security. The risk: if the market recovers during that window, you miss the rebound. The second method is the approach the pros use. Swap into an ETF with a clearly different index and holdings composition. For example, sell an S&P 500 linked ETF and buy one tracking a different index. That said, the interpretation of substantially identical exists in a gray zone. The IRS has not published a clear, definitive standard. For combinations where the indexes or investment objectives are too similar, proceed carefully, and when in doubt, consult a tax professional. One additional note on crypto assets. Under current law, cryptocurrencies are not classified as securities, so the wash sale rule typically does not apply. That means you can sell, immediately buy back, and still realize the loss, unlike with stocks. However, legislation to extend the rule to crypto has been under active discussion. Stay current on any changes. Only those who understand the rules can harvest tax savings legally. So how do you actually implement this? 4 principles. First, execute only in taxable accounts. In retirement accounts like IRAs and 401ks, gains and losses within the account are generally not reported as capital gains or losses in the current tax year. Whether it's a traditional pre-tax account or a Roth after-tax account, the tax treatment differs, but realized, gains and losses inside the account are not reported on your return. Understand this. Tax loss harvesting is a strategy exclusively for taxable brokerage accounts. Second, prioritize realizing short-term losses. Short-term capital gains on assets held less than 1 year are taxed at ordinary income rates, a progressive federal scale from 10% up to 37%. For high earners, add the 3.8% net investment income tax, and the effective maximum hits 40.8%. Compare that to the 20% maximum on long-term gains. That gap is exactly why short-term losses come first. Third, understand the precise order of netting. Start by netting all short-term gains and losses to arrive at a net short-term figure. Then, net all long-term gains and losses to arrive at a net long-term figure. Finally, combine the net short-term and net long-term figures to calculate your overall result. Handling gains and losses at the right tax rates maximizes your tax savings. Fourth, don't limit this to December. Execute year-round. By December, selling pressure builds as many investors do the same thing, and prices can distort. Review your holdings quarterly and act on opportunities as they arise. That's the professional approach. There's a concept you absolutely must understand before executing tax loss harvesting: the difference between long-term and short-term capital gains. Miss this distinction, and you could end up worse off thinking you're saving taxes. Let me break it down simply. When you sell an asset held for more than 1 year, it qualifies as a long-term capital gain. Using a single filer in 2024 as the example, taxable income up to $47,025, 0% rate. From $47,026 to $518, 900 to 15%. Above $518, 900 to 20%. Keep in mind, these thresholds apply to single filers. Married filing jointly and other filing statuses use different brackets. And remember, these are federal rates. State taxes apply separately. Short-term gains, on the other hand, assets held less than 1 year, are taxed at ordinary income rates. At the federal level, that's a progressive scale from 10% up to 37%. For high earners, add the 3.8% NIIT, and the real ceiling reaches 40.8%. Run the numbers on $100,000 in gains. Short-term at 37%, that's a $37,000 tax bill. Long-term at 20%, $20,000. A $17,000 difference. 1 extra day of holding can create a $17,000 swing. When building your tax loss harvesting strategy, always identify which type of gain you're offsetting. Net short-term against short-term, long-term against long-term, then reconcile the remaining net figures. That's the correct sequence. Let me be direct with you here. Executing tax loss harvesting perfectly by hand is hard. You're monitoring the market daily, tracking the wash sale rule, and timing your trades all at once. Emotion gets in the way. Things get missed. That's where automation tools come in. Robo-advisors like Betterment and Wealthfront run tax loss harvesting automatically, every single day. Every time the market moves, the algorithm scans your portfolio for loss realization opportunities. The wash sale rule is checked automatically. And there's no emotional decision-making pulling you off course. According to Betterment's analysis, under specific conditions, automated tax loss harvesting has demonstrated the ability to enhance after-tax value through mechanisms like tax deferral. But understand this. The magnitude of that benefit varies significantly each year based on market volatility, your personal tax rate, timing of sales, and transaction costs. Past estimates do not guarantee future results. The fee is 0.25% annually. On a $500,000 portfolio, that's $1.250 per year. Whether the convenience of automation justifies that cost depends on your asset size and how much time you want to spend. That's your call. For investors with $500,000 or more, direct indexing, owning individual stocks instead of funds, opens up even more granular tax loss harvesting opportunities. Lower cost, greater precision in tax optimization. Now let's lock in the key takeaways from today. Here's your summary. First, tax loss harvesting is a legitimate tax strategy. You offset losses against capital gains to reduce your taxable income. Excess losses can be deducted from ordinary income up to $3,000 per year, or $1,500 if you're married filing separately. What's left carries forward with no expiration. Losses don't disappear. They build as future tax ammunition. Second, understanding and avoiding the wash sale rule is non-negotiable. Buy back the same security within 30 days of the sale date, including the sale date itself, and the loss is disallowed for the current year. That disallowed loss doesn't vanish. It gets added to the cost basis of your replacement shares and deferred to the future. Note that under current law, crypto assets are typically outside the scope of the wash sale rule, but with legislative changes under active discussion, keep up with the latest developments. Third, understand the gap between short-term and long-term capital gains tax rates and use automation to amplify your results. One extra day of holding can create up to a 17% tax rate difference. Just know that the impact of automation tools depends on your market environment and personal tax situation. Results are not guaranteed. Does your portfolio have any assets sitting at an unrealized loss right now? Those losses could be an opportunity for tax savings starting today. Share your strategy in the comments. Your tax loss harvesting approach, your questions, your wins. Every insight strengthens this community. Thanks for investing your time with me today. This channel covers concrete tax strategies like tax loss harvesting, asset allocation, the power of compounding, and actionable roadmaps to financial freedom, all driven by numbers and blueprints. If you want to build wealth through math, not emotion, hit subscribe and turn on notifications. I'll keep delivering the insights to accelerate your wealth building journey. See you in the next one.